G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment, and I'm Pete Wargent from Alan Wargent Property Buyers. And this week, I'm delighted to say we've got Chris Bates from Alcove back from his European travels. G'day, Chris. How was the trip?
Oh, it was good, Pete. But you'll like to hear this. I've absolutely missed this. The amount of times over the last 4 or 5 weeks I've sort of read something or thought about something. Thought, God, I wish I was chatting to Pete. There's not many things I've missed as much as this. So it's good to be back. The trip was good. Haven't spent that much time in France before. I've been to Paris a few times just for weekends and things like that. But haven't really explored the country besides an old football trip to Montpellier when I was living over in London a long time ago. And it's a great country. It's so diverse and just so many elements to it. There's so much history as well. And Bordeaux with some friends, all down the French Riviera with the family. The biggest takeaway is just it's those moments with the kids, right, where you've got no distractions of work or got to be anywhere, and you're sort of just sitting there playing with the rocks with your boy, or having an ice cream with the girl and walking the city. It's those moments. Plus, some long overdue family time in the UK. I've got family over in Liverpool. I haven't seen my grandma for 3 years, and my daughter and my boy haven't really met them, so they got a good time, and some cousins. So it was all the elements to the trip. How have you been?
Amazing. Yeah, every time the Tour de France is on, I watch all the scenery and all those chateaux, and I always think, it's a beautiful country out there, especially in summer. So, look, I guess just like yourself, I've been grappling with, being an expat and just aging parents, trying to do a bit of that because, I guess sort of sort of sprung up on me quite quickly, but sort of parents are getting on. We've had a family funeral to go to in the last few weeks. So, just grappling with a bit of that. Other news outside of work anyway, I've got been getting the cricket whites back on actually. So, I'm down back at Lord's actually tomorrow as we record this. Got an interview down with the MCC. So, that's just keeping me busy. I won't bore you with the details, but I'm back to Oz next week. Got a week in Perth coming up actually, which is pretty good because I haven't been over there for 6 months or so. So it'll be interesting to see how the Perth market's going. But certainly the feedback I'm getting from the team particularly in Brisbane, actually, just very tight buying conditions. The guys keep missing out on properties, sometimes 4 or 5 times before we get one bought. So and you can see that being reflected back in all the data. Brisbane leading the property price increases again. Queensland economy sort of booming along on all the consumer and business surveys. So, how about in the mortgage world? I saw this week another couple of banks offering fixed rates under 5% again. So is there a bit of a mortgage war heating up?
Oh, I don't think on the refinance war is really there. But, the good thing is that when I started the business, it was just me, and it was just me probably for the first 4 years, I think. And very lonely world that was. But then Ben joined in 2018, and we've had a bit of a journey. And luckily, there's a bit of a team when I go away. It's not just the business guy goes to a grinding halt. And we've had a huge month in August. I'm not someone who likes to hype it up, but you can just see. It's probably just consistent new inquiry. I wouldn't say that's really dramatically increased, maybe just a fraction, coming out of school holidays and things like that. I wouldn't say it's gone nuts. Definitely the last couple of weeks, it's gone up quite a bit, new inquiry with all which we'll talk about today, the 5% deposit scheme. But really, we actually had more clients lodge than new clients come to us. So it's a lot of those clients who have talked to us over the last few years that, whether they're existing clients or whether they've just been what we call sort of, someone who's just waiting for some reason, whether it's savings or family or life situation. And we've had a huge month in August. Now, I don't want to talk the market up too much because like you say, Pete, listings and affordability are absolutely still a constraint. Yes, you're pre-approved. Yes, you want to buy, but that doesn't mean you can go and find something. And I think that's just going to be the real challenge. We both sort of chatted about this in sort of May, June. And I just said, I think spring's going to be pretty lackluster in terms of listings. I just think people are going to be sitting in their hands. I don't think investors aren't going to want to sell because they're going to want to play the market momentum. And when, CoreLogic sort of, I shouldn't say that, Cotality, sorry, the CoreLogic team, released their monthly figures yesterday. It's just that flatlining of listings, right? Like we are way down as a country of amount of listings, and spring really hasn't sprung. Maybe it's too much rain, Pete. What have you noticed on the ground as well?
Yeah, I think it's well, you can see transaction volumes are actually picking up. I was just looking at the Office for State Revenue stats for New South Wales yesterday, and transaction volumes are up, prices are up, and so the stamp duty take is another sort of a boom getting underway for the New South Wales state government. So I think that's a big cause of the low total number of properties on the market. It's the old cliche, more buyers than sellers. But so if you look at the number of listings nationwide, it's actually more than 20% lower than would be normally the case for this time of year. So yeah, I had a scroll through the Cotality chart pack. I guess the key sort of takeaways, yes, very low listings, but also rents are re-accelerating. But they never went down in this cycle, but they did seem to be at least sort of calming down a bit. But in recent months, that's been taking off again, which it's hard to get a read on it, but it feels like immigration has picked up again at a time when we've got very little housing supply coming through. So that's one to watch from an inflation perspective. So yeah, it's pretty interesting. I suppose the other thing that I don't know if you caught this, you may have been on a long haul flight, but just some early sort of talk about job cuts. ANZ's cutting 4,500 roles over the next 12 months. NAB then followed suit the next day. So that's just a little bit of a turning point. Not something we've read a lot about recently, but of course, when the big employers are cutting roles, that's when that working from home debate sort of hosed back into view, because ANZ was one of the firms that was trying to shoehorn people back into the office, and now they've cut a whole load of roles that could be offshored as well. So yeah, I guess I'm not sure if you caught that one on your travels, or maybe you were still en route.
You know, one of my favourite stories is that, Pete, at the is this work from home sort of debate.
Yeah, not the job cuts.
I was chatting to some friends. I won't say who they work for. One's a big supermarket, and the other one's a big tech firm. They've had some major changes, both of them at the same time. They live right in us up in the upper beaches, and one's got to go in 3 days, and one's got to go in, I think it's 2, which is a big jump from where it is in the tech world. And and it's mandatory, and you have to be in on these days. And and they've had a pretty good. They've had a complete working from home. No real pressure to go to the office. Maybe 1 day a week, if that. But it's you can sort of get around it if you want. And so, yeah, I do think this is flipping to this hybrid work's getting pretty set in stone. And at least for the short term. I mean, job cuts. I mean, Nuno at ANZ's got to have to sort of put his stamp on ANZ, right? And I think that's what he's trying to do. But it's also interesting that NAB, I also read an article, CBA have sacked a lot of people and they had to rehire. I'm not sure if it was just an AI, anti-AI publication, but basically saying that, people had to rehire after they try to replace workers with AI. But we'll see how that one goes. And but yeah, I think overall, confidence is there. I mean, I track the ASX tracker in terms of interest rates like you do, Pete, like religiously. I just want to see that confidence around where rates are going. And there's probably a little bit less confidence, probably one less cut, I'd say, Pete. I don't know if you think the same, is what the market's pricing in this year. But it's still saying maybe 2 more, maybe up to 3, potentially, next year. So that's been pretty steady, I would say, Pete, compared to the last, since maybe 21, 22, that was bouncing around like a yo-yo. We had no idea whether, how high rates would go. And then we thought rate cuts were coming, and then we thought rates were going to go, up, and then, they're coming, you know what I mean? So it's been a bit like that. I mean, what have you also noticed?
Yeah, one of my sort of more contrarian views in recent times has been that I don't think we'll get much more monetary easing in this cycle. It's just not based on any specific data set, but just every time there's a sort of a release from the ABS, it just seems that everything's turning a corner and picking up again. So I think the one sort of thing to watch is unemployment. If that starts spiking up, then yes, we will get the rate cuts. But just all of even from a sentiment perspective, Westpac put out their consumer sentiment survey this month, and yes, a bit of a pullback, but way higher than where we were a year ago. And actually, one thing that jumped out from a property market point of view, house price expectations, that index normally runs somewhere between 120 to 130. Well, it was 168. I mean, that's
wow. I haven't seen
that's
that.
the highest level since 2010. So what's that, 15-year high? So all of those things, yes, there's a bit of a lag with monetary policy, but maybe we don't need much more in the way of cuts. Before we get on to the 3 news stories of the week, there was just one other article I called from Nerida Conisbee on LinkedIn from Ray White, just talking about how it's the most affordable segment of the market that is outperforming now. So she's just said nationally affordable housing or houses, 25th percentile, are growing at 8.3% compared to 8% for typical properties. The same's true in the unit market. And in particular in Sydney, the most affordable housing is outperforming quite significantly versus the middle and higher price points. So that wouldn't be the case through the whole cycle, but I think it makes sense. We've got the 5% deposit scheme coming. We've got investors coming back into the market, and they're often active in those lower price points. And it's true across the capital cities, also true across the region. So we'll link to the article, but I guess that could be something that characterizes this cycle, that it's driven very much from the bottom upwards rather than the sort of premium properties leading the way.
Yeah, but I think the irony of that is, Pete, the more affordable part of the market is now becoming more unaffordable, and I think that's going to lead into probably one of our stories here. Is one of the I guess unintended consequences of the new policy that they're doing for 5% deposits.
Yeah, well, let's crack on with our big 3 property news stories of the week. So if you're not familiar, every Sunday at 7 a.m. in your podcast player, this is what we do, the big 3 property news stories. And we do a listener Q&A at the end. So we've got a few of your questions to cover off. So stick around for those. Well, the first news story this week, Chris, was actually a newsletter from Alcove. We don't normally publish those, but I was interested because obviously you were traveling in Europe at the time. So yeah, a bit like yourself, I sort of grown a team over the past sort of dozen years or so. It was initially just me. And actually when COVID happened, I was actually forced to be able to work remotely because I got stuck overseas for a period of time. So I was quite interested to see the newsletter hitting the inbox while you were sort of gallivanting around Europe. So interesting piece, 4 reasons first home buyers should use the 5% deposit scheme. So I guess just in bullet point format, I guess the main points you raised were there's no longer income limits or income caps on this scheme. We've got higher price caps for properties that you can purchase under the scheme. Borrowing capacities have picked up a little bit in recent times as interest rates have gone down. And mainly just, I suppose, the market momentum that has already turned a corner. So I suppose, yes, it's not something to sort of panic about and dive into the market thoughtlessly, because there will come a time when interest rates are going back up again and you need to sort of think through the full cycle. But I guess based on those 4 points that you raised, if you've got 5% deposit ready to go as a first home buyer, it probably makes more sense to use that now rather than spend the next 12, 24 months saving a bigger deposit, because I suppose more likely than not, if you look at every forecaster out there, they're talking about prices being higher a year or 2 from now. So on that basis, those are your 4 reasons why first home buyers should use the 5% deposit scheme, creating a bit of a FOMO in the market, particularly at the lower end, I guess.
Yeah, I mean, if anyone watching on YouTube, you can see I'm wearing a different T-shirt. It's not a illusion of your imagination. We had a bit of a glitch in the system, so we're recording this for the second time. So if we do say things that we've just said for the last 15 minutes, that's because we had to re-record this. But yeah, it's a funny one. This this post sort of came out when actually I wrote this a week before all the announcements for the 1st of October, bringing it forward. I think I was away obviously in France, and I was just thinking, this 5% deposit scheme, no one's talking about it. Everyone should be talking about it. It's huge. It's coming out in January. We were encouraging our clients who were investors to sort of get ahead of the wave, buy where the 5% deposit scheme is most likely going to affect the most from January onwards. And I was just always expecting it to start to come out, the news, and it just wasn't. So I thought, I better just get it out there. And so I did a post. I had to think about, the major reasons why first-home buyers should take advantage of it. And the post went viral. I mean, we've had a few things over the years go, through the the algorithm and seemed to get picked up. This got close to 500,000 views, I think. And it obviously because no one really knew about it. Then a week later, if that, the news came that they brought it forward to October 1, and then it was everywhere. And we've seen a huge impact just in terms of over the last, in August, in terms of a lot of first home buyers have come back, who we've spoken to for years and years and years. And every single, got to remember there's 20,000 brokers in the country that, want to grow their businesses. And then all of a sudden now they're marketing to all their databases and all their first home buyers in the past, trying to also encourage them to take advantage of it. So I do think it's going to create a lot of demand, between now and the new year. But the major reasons why it's so powerful is that it's any first home buyer, like it's not you're on too much income, or you want to, and the reason why it's probably any first home buyer is because it's up to 1.5 million in Sydney, 1 million in Melbourne and Brisbane, and in other cities, etc. So it's at a high enough level now where you can get a great asset that's inspiring, that you want to live long term. It might not be your dream property, but it's a good asset and it's something you really want to live in for a first home buyer. And so you can't say you can't find something good, and you also can't say, well, I don't qualify because I earn too much money or something. So borrowing capacity's gone up a lot, and every borrower is spending every dollar they've got. 3 rate cuts, that's like a 7-8% increase in borrowing capacity. We've had some changes to HEX. We've had some changes to way banks look at, longer term loans and things like that. Let alone if there's another 1, 2, 3, between now and, early next year, let alone if there's some changes with APRA, borrowing capacity's up. So there's some of the major reasons why I think first home buyers really need to consider this opportunity, and there could be a decent opportunity cost if they don't.
I think so. I think, as you said, the time to prepare is now. Normally, traditionally, a first home buyer would look to save around 15% of the property value. And if you don't have to do that, you could spend longer saving, but you're probably just going to be paying more for the property is the reality. So, it's not about being panicked and rushing into the market, but obviously you need to try and buy well. But I think it could be a false economy to wait in this circumstance, just because we've seen with it every time the government gives these schemes or puts these schemes in place, like the home builder, or sometimes there's stamp duty exemptions, inevitably people take them up. And I think this will be no different. So, I think speak to your mortgage broker. And if you've got that 5% deposit ready to go, it's probably a smart line of thinking to consider using it. So let's take a look at the second story of the week. It's actually 2 stories on the supply side. CBRE put out their apartments report, and maybe not that big of a surprise, but fewer units than expected being delivered, I guess, for all the reasons we already knew about: cost overruns, fixed price contracts, and a lot of insolvencies across the development and construction sector. If you look at the projections for the next 5 years, about 60,000 apartments per year are expected to be delivered by CBRE, but they estimate that around 75,000 a year would be needed to avoid further falls in rental vacancy rates. So I think, there's different ways to measure this, of course. I think CBRE has said that the decade average for a rental vacancy rate in Australia is about 2.5%. Well, we're currently well under 2%, and they're projecting that will fall to around 1% by 2030. So this is pretty alarming stuff. I saw this week another ABS release on arrivals and departures figures. It looks like it's for a 7th consecutive month. Immigration has most likely been re-accelerating. You might have missed a bit of this, Chris, while you're away in Europe, but there's been a debate about whether we should or shouldn't be using arrivals and departures figures to project what immigration's doing. Of course, the correlation historically has been very strong. But the ABS said we shouldn't. But putting that to one side, it's quite alarming that we could see the housing shortage not actually improving, but getting worse for the next 5 years. Already we're in a critical shortage. I think the other side to this story, there was a nice piece in the AFR about 12 homeowners in Mosman clubbing together to make a sale to a developer for a huge $750 million development. So that's in an upmarket part of Sydney, New South Wales. The New South Wales government is fighting very hard to improve apartment supply. So whether or not it will be enough, I don't know. But at least you can see that genuine efforts are being pulled out here to try and actually get the apartment supply moving. Because if you take CBRE's projections at face value, the housing shortage is just going to get worse and worse and worse. And by their estimate, by 2030, a 2-bedroom apartment will be renting for over $1,000 a week, based on their estimates of a 24% increase. So what do you think?
Look, I actually did a post on this on LinkedIn as well this week, and it's quite a divisive one, to be honest. I've had a bunch of people reach out to me, even clients, saying, I like your sentiment, but I disagree. And I'm up for debate. That's what I love to think about this. And I've sort of held my shot on this, I guess, regarding my opinion on it. I've sort of been watching Chris Minzer the last couple of years. Sort of, what's your game plan? Like, how do you see this all playing out? And are you actually able to move the needle and actually get override councils basically that have not basically allowed any building in their postcode or their area for some time? Are you actually going to move the needle? And I think, just looking at Chris Minns has gone about, he's basically on a 2-year crusade to take on the NIMBYs. And so what basically you're saying is that parts of in Sydney, in this case, where they haven't been building, is it really fair that, the western suburbs of Sydney, let's call it, is taking on the brunt of new properties for Sydney, and there's nothing getting built in the more affluent areas of the city? Should we just put all our apartment towers in one pocket, or should we spread them across the city, where it makes more sense, And I think he is. I think the Rose Bay sort of Double Bay area is going through a lot of change. And I think, this site in Mosman's not so much on the main road, it's deep in the suburb. That's the interesting thing for me on this. It's not where you would think a developer would go to first. And it might stand out like a sore thumb, but that also may mean that other developers like that are going to start popping up around it. And I think suburbs have to change. I mean, I reflect on in London. I've thought a lot about this when I was, at the London Transport Museum, and there was 5 million people in London in 1901. And I was thinking, how the hell did they make that happen? And, there's only 9 million in London now, but the city has to keep evolving and changing. And, and I think, you could say, is the Sydney economy going to grow? Is more people going to be here in 10, 20, 30 years time? Probably. So I think we just need to play catch up here, because, the issues today are only going to get worse unless we start to make some shifts. And some people are going to get affected by it. Suburbs are going to have to change, but that doesn't mean that they shouldn't. I just think we have to, and if you are looking to buy or invest in these, in Sydney, for example, you nearly need to take this new information and go, okay, well, this is the way. This has been a change to the game here. We're going to start to see more development, not just on the fringes in these sort of pockets. They're going to be more spread across the city. Okay, do I want to buy something that benefits from that? Or, and do I want to avoid certain properties that would be affected by that? And I think you can make that switch now. So I think it's, but yeah, obviously people who own, that's my take on this, Pete. I think the whole, blaming migration, what do you just cut it to zero? Do you? Okay, well, that doesn't solve anything, does it? Right? There's going to be other problems, unintended consequences. I think it's, we need to actually just take and evolve as the city needs to grow.
Well, historically, there's been certain LGAs that have provided effectively no net new supply at all. If you look at Manly, Woollahra, Mosman, well, it depends whereabouts, as you say, in the LGA, but it could be a bit of a shift. I think in London's case, a big part of the shift was the extra business district that evolved around Canary Wharf and all of those areas. And maybe in Sydney's case, yeah, that's right. And even Midtown. I think in Sydney's case, maybe more out west towards the new airport, potentially. So we'll see how that story evolves. So third story this week before we come on.
As well, Pete, throw that in there as well. Like, there's an article around the cost to build too much. And, that's the reason we're not getting all these apartments. Well, that's true. So why don't you create more options for developers where the cost to build plus the cost to land is still feasible, and we can keep adding supply on, and, and rather than doing no building because they can't make the numbers stack up, they're actually going to allocate and build. And even if it doesn't suit first home buyers, I do believe that if you get people, you build in these affluent areas like Rose Bay and Mosman, where are those people coming from? Often they've got houses that are too big and they're rattling around and they've got spare bedrooms. So they free up that house for the next generation to jump in, who might be in an apartment that needs a house. And, and at the moment, there's nothing for them to downsize into. It's one of the biggest problems in our property market is that we've got all these spare bedrooms for people who haven't got properties they want to downsize into. So a lot of people say, like, you're only building properties more for the wealthy. Well, No, you're actually just creating more supply, which is what we need. And there's some cases where they're actually reducing the amount of supply. I think there's one in Potts Point that is a bit, and there's others as well where they're knocking down, say, 30 apartments and building 12. You've got to really be worried about that. You're taking out a lot of affordable housing to help the downsizers, but that's not often the case. Often it's the case of increasing the supply rather than decreasing the stock. And when you think about this case in Mosman, they've removed 12 houses for what, 60, 80 apartments? I don't know how many it's going to be, but it's a lot more than 12. And so I think that the cost to build, it's there, but you don't expect building prices to go down, and prices will naturally probably go up. So they'll get more feasibility and they'll maybe be able to build more affordable housing in time. But that's the other thing with this final thing. I'm a bit passionate about this, Pete, is that, part of the incentive for the developers, if they build a bit of affordable housing as part of their stock, they can build more. And so they actually are building some more affordable housing within these developments because that makes their feasibility a bit better in terms of how high they can go.
I think that's right. Even if the new apartments are expensive, in the end, extra supply is what brings down rents and ultimately can help to solve the housing shortage. So before we do our listener Q&A, just one more story this week, third and final story. House prices spring-loaded to boom. So this was the Westpac sentiment survey, the Housing Pulse, and also Macro Business called covered the same story. So Westpac's Housing Pulse said there's been a discernible shift in the housing market. Buyers are perking up. Price growth is lifting. Auction clearance rates are rising. Supply tightening. So I guess no big surprises there. The time to buy a dwelling index surged another 10% in August, buoyed by Reserve Bank of Australia interest rate cuts. I think the other thing as well, if you look at house price expectations, normally that index runs between around 120 to 130. It's gone all the way up to 168. That's the highest since 2010. So that's a 15-year high for house price expectations. So you can see the direction of travel. I was interested to see as well just the recent trend in auction clearance rates. Shane Oliver puts together a nice graphic every weekend. And if you take that at face value, the correlation between Sydney's auction clearance rates and home price growth, well, we're looking at 25% price growth. If historic trends prove to be any guide. Now, of course, we're starting from a higher base and maybe things don't play out exactly like that, but you can certainly see where the sentiment is moving to. So how do you think this cycle's going to play out, Chris? I did see Nerida Conisbee again on LinkedIn saying that the spring selling season has really started with a fizzer for new listings, just out this morning that was. So just as you've been predicting, actually, maybe we're not going to get as much supply come through. So, I mean, that would be the one thing which would cool housing price growth if we got more people listing. But so far, the signs aren't particularly good.
Oh, look, I think the upgrade is that, you've got obviously first-time buyers and investors often competing on the same property. So I think the more affordable part of the market, which has been growing the strongest, is probably going to be the one that still outperforms. But I do think there's a lot of pent-up demand in the sort of housing and the upgrader market that want to upgrade but haven't really got the ability to do so, or already have property and don't want to take on that debt. But every time there's a rate cut, they sort of get a bit more interested. And so I don't think it'll happen in the next 3-4 months, but coming into 2026, I think that's when the market will really run. Obviously that's where a lot of the wealth is within the property market, is in the housing market. A lot of first home buyers and more the investors just can't afford to get there now. And so, the 5% deposit scheme is absolutely going to create a lot of competition at the, under those caps. But I think the upgrader market sort of sitting on their hands, and that's why listings are low, right? Because they're like, well, yes, I might prefer to be in a different suburb or a bigger house or a different location within the suburb, but I'm not going to do that right now. And so I think listings are going to be pretty dire coming into, but and I think you're right. The time to buy index has gone up and the price expectation. So that's sentiment, that's the sentiment of the market, of where the market's going to go, and it's becoming much more positive. I think consumer sentiment's jumped a lot since the over the last couple of years as well. So I mean, there is a bit of job concerns, with the banks letting go, and there is people still a little bit frightened over the last few years as well. Like a lot of people who didn't have a lot of debt would have been like, oh, I'm so glad I didn't upgrade. You know what I mean? And so that might take a while for that, recency bias to stop, to encourage upgraders to upgrade. But it's like when people were taking on a lot of debt in COVID, rates are going to stay zero forever. That's this overconfidence bias. There's probably this over conservative bias that might take a while to sort of wash through as well. I don't know if you see that too, Pete.
Possibly, yes. Although I guess historically, the correlation between house price expectations and what actually happens does, even if there's a bit of a lag, it does generally map pretty accurately. So yes, I think it usually takes a few headlines about rising prices and first home buyer booms and investors piling in, and then suddenly it becomes a bit of a self-fulfilling prophecy in the sale, and that's why we get the market cycles. Really, it's driven by sort of fear and greed, as all financial markets are. So we've just got time for a few listener questions before we wrap up in our Q&A. So first question from Pondering Pete: with the first home buyers coming in October, would you be best selling a property in November 2025 or February 2026? I'm selling an investment house in Campbelltown, New South Wales. So yeah, I mean, you could look at it a couple of different ways. I suppose the missing piece of information there is what you're planning to do with the funds. Are you looking to parlay that equity into another investment, or are you going to do something else with the money? Look, I would say the market's going to be pretty robust in November, so I'd probably go with it. I'd probably sell this side of Christmas because, generally mid-December through to Australia Day is a bit of a black hole for auctions and for certainly for new listings. How about you, Chris? You take the other side of that one?
It's funny, Pete, because we've already answered these questions, you and I, together on the last recording.
Inside info.
Yeah. So, but yeah, I probably would. I mean, I think there's a lot of momentum in the market for first-time buyers. I think that February time comes around, and you often find that you get surprised with how much the market jumps because you get to Christmas, and it's probably like November onwards. I think all the listings will get snapped up, right? And I think that's when you can see auction clearance rates. The desperation meter starts getting above that sort of 60-70% mark. And all of a sudden, all the stuff gets sold, no matter how good it is, and that's really what it is. It's basically saying whatever the quality, if you get 100 auctions, if 75 of them are selling it, it's not because they're better than it was 6 months ago. It's just that people are more desperate, right? They're willing to buy things they wouldn't have been able to buy under competition at auction. So, I reckon that all the momentum's in your favor. And so if you're not really, if you're just really selling out to put the money to pay off your mortgage or to put money into super or something like that, maybe you should just gamble for another 3 months. I mean, but you're right, Pete, the big question is that what would you do with the money? What's the next move? And that often matters just as much as what you do with the current situation.
True. I mean, look, the world could end between now and February, but current
right?
Trend at least is up, so we'll see. Okay, second question from Losty. What indicators can I use to determine which phase of the property market cycle we're currently in? I'm looking in Southwest Sydney, New South Wales, so a bit of a Southwest Sydney theme in today's questions. Look, there's two different things here. There's the macro and the micro. I would say, I think at the macro level, you generally would look at the number of listings on the market, and if that's trending lower, sort of an old cliche of markets, that means more buyers than sellers. If that's not a sort of contradiction in terms, but it does mean that the sort of the sentiment is moving in the right direction for prices to go up. If listings are, on the other hand, trending higher, then the opposite is probably true. But I think that having been said, I think you don't really get a better read on the market than actually just being there at open homes on the weekend. I say, you can sort of tell as a buyer's agent. I remember in my early days as a buyer's agent, if you went to an open home and there is kind of nobody there and the agent's having a smoko on the balcony, then that sort of suggests, well, look, there's not much heat in the market. You could probably get it's going to be a difficult time to sell and a much easier time to buy. But if you turn up to the open home and there's 25 pairs of sand shoes out the front and there's people bustling around and taking contracts and getting straight in the agent's ear, well, straight away you can see that's going to be a seller's market. So, yes, I think there's certain macro indicators you can look at, and you can look at sort of asking prices and the number of listings, but there's, in the end, no sort of replacement for actually getting out there, going to some auctions, going to some open homes, seeing what properties it's selling for, particularly in your locality and the sort of property types and locations you're looking at. And if you can't do it, maybe send a friend down there if you can't make it.
I think that's absolutely the right answer there, Pete. Macro, absolutely understand where we're going as a, like you said, that Westpac survey, auction clearance rates, days on markets, vendor discounting, listings, search data you can look at. There's so many things, right? And I think this is where people sell courses on how to invest in properties, looking at all these macro trends and things like that. I think what they often miss, and this is one of the issues with borderless buyers agents, if I'm going to have a bit of a shot, is that, those things matter. What matters is that local knowledge, that street local data that you can see and going, actually things have, based on my experience, I've been buying in this market for 10 years. This is a hot market. I've seen down markets. I know what it's like. I know what things are busy. And I also know what people want in all those markets. I know that in hot markets, people will buy anything, but in the cold markets, they really want these markets. And this is these type of properties and they love these. So, and if you can see, I think the best indicator is that people are going nuts for the poor properties. Well, that's probably a good sign that there's a lot of momentum in the market. But if they're not selling, they're just sitting on the market for a long time and, even the good properties haven't got much demand, well, then that you're in a tough market. So I think it's just that real knowledge, and looking back over time, you can look at listing numbers over time and you can get a real good grasp of where you are in the cycle. But, nothing beats going to an auction property, auction, Pete, and then auctions at different quality of properties as well, and at different price points. In the last few years, you've seen that certain price points within suburbs have had a lot of competition. You go, $500,000 more and there's no one at the open homes. Doesn't mean, and also this is because people's budgets have been tight. And so, if you're buying at that lower end, you go, it's market's going nuts. You go to the property that is 500 grand more, you're like, oh, it's really quiet out there. Well, no, it's just the market segmentation and where you're looking. So, hopefully that was helpful, Pete. Hopefully we don't ever have to record twice again, because it's always weird. You don't know what you've said and what you haven't said. And so hope you have a good weekend, Pete. I think you're going to Lord's. Anything else going on?
No, not really. So I've got an interview down at Lord's this weekend. So just a bit of time in London, catching up with a few Aussie mates, then back to Australia next week. So I was impressed with your array of wardrobe and available t-shirts for today's recording. So what about yourself? Any plans for the weekend?
I did have my new t-shirt. We had a new website launch. So check it out, alcove.com.au. Throw in that last plug. It was 8 months of stress, to be honest. Don't ever rebuild a website. I think I've done it 5 times. So let's hope that's the last one for a while. But I went for the nice white t-shirt today. Nothing going on today. This weekend, really, I think it's 4 birthday parties, or it's 5, or it's a ridiculous amount. So I'll be over talking to families at 5-year-old birthday parties.
You must know more people than I do, but Anyway, so come and join us on the true. Come and join us on the Rask Community Forum. That's community.rask.com.au. Come and join the chat. It's not just property, it's stocks and shares and business and financial markets, and it's all free. So come and join us there, and do send in your questions for next week, and Chris and I will cover those off too. And looking forward to getting back to us next week as well. So thanks everyone, and thanks Chris.
Thanks, Pete. Talk soon.
See you next time.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.